Alrighty. So in today's video, I'm going to be talking about the top 5 deadliest wheel strategy mistakes that I see many people make, right? So I've been trading the wheel strategy for quite some time now, and I even shared it in my own portfolio, right? What are the stocks that I've been wheeling and how I trade it. So you can definitely just go to my channel and just look for, the 7-figure portfolio, right? So I share what's inside my portfolio. So for the wheel strategy, it has been actually doing pretty well for me. And the reason is because I have been avoiding the mistakes that I'll be mentioning in this video. So if you too want to do well in your wheel strategy and definitely avoid getting into stocks where it can potentially go to zero, then you definitely want to watch this video. All right, so let's dive right into this, starting with the very first mistake, and mistake number 1, and that is to just choose high volatility stocks and not profitable companies. So in my opinion, this is the biggest mistake that I see many beginners make, right? They just go for the very high volatility stocks because they think that it's going to give you a lot of premium. But the problem is that when you go for this high volatility stocks, it's actually increasing your risk. So many people love to trade the wheel strategy on high volatility stocks because it gives high premiums. Now, first of all, nothing wrong with high volatility stocks if it is also a profitable company, right? So if you tie these two together, that's fine, right? But if you're only focusing purely just for the very high volatility, right, because you want to get a lot of premiums, then this is where it can get into a lot of trouble, a lot of problems later on as you trade it, right? If you're just focusing on getting as high as volatility as you can. So as you can see, this is AMC. So AMC is a pretty popular stock, right? It's one of the meme stocks amongst, many people trading it, especially those with small capital, because they can get quite a big premium, right? So one of these stocks, the meme stocks, is AMC. You have another one down here. This is NEO. As you can see, look at the volatility down here, over 100% for most of the option expiration dates, right? And then also GME, right? The ever popular GME. As you can see over here, the volatility also pretty high. But what many people don't realize is that the higher the volatility, it indicates the higher the potential movement of the stock, which also means that there is a higher risk, right? Many people just think of high volatility as high premium, but they don't really understand what does it actually mean. High volatility just means that the range of the stock, the movement of the stock for that period will be quite big. So this is the range of a given stock. So if you compare a high volatility versus a low volatility, right, you will see that the range will differ from this. So you get a higher premium only because the chances of the stock actually moving very big is higher. Which means to say, let's say, for example, you get into the stock somewhere at this level down here, right? Let's say, for example, you're selling a cash secured put somewhere here. Now, in the event there's going to be a very big move, this stock, which you're chosen with the high volatility, can move so much more below your cash secured put compared to the one with low volatility, because it's going to only move a smaller range. So with a smaller range, your loss won't be as big compared to a high volatility. Now, of course, if the market shoot all the way up, then if you sell a cash secured put, then of course it's going to be in a profit. But we must always take into account the risk as well, right? You don't just want to see how much you want to make and then you ignore all the risk involved with this. So this is the problem with high volatility stocks. And one of the other major problems is that many of these high volatility stocks is that they are unprofitable companies, right? So remember, whenever we're choosing any stock, it's not just like a name or a ticker down there that we're just trading as a game. No, because whatever that you're trading, every stock is a company, right? So either the company is profitable or not profitable. Many of these high volatility stocks are not profitable. For example, AMC, right? So you can very easily go to Google Finance and just take a look at their income statement. As you can see over here, this is AMC. For the past 5 years, they have not been profitable, right? As you can see, the orange, or rather the yellowish bar, this is the net income. And for all the past 5 years, it is under zero. So this company has not been making money for the past 5 years. Now you might be saying, "Oh, Davis, but the net income is gradually getting better, right? The losses getting smaller and smaller." Yes, that may be true, but at the moment, it's still a losing money company, right? The company is still not profitable. So you want to wait till at least it turns profitable, then you can decide, okay, maybe this might be a possible candidate for the wheel strategy. But at the moment, it's still a losing money company. It's not profitable. I would suggest not to go with AMC. Now, what about NEO? So whenever I look at a company's income statement, generally what I like to look at is increasing revenue and increasing profits, right? Increasing net income. But NEO is a very classic case of divergence where you have increasing revenue, but you have increasing losses as well. As you can see, the more they sell their cars, right? The more cars they sell, the more revenue they make. They're actually losing even more money, right? As you can see over here, this last bit down here, they make the most revenue out of the past 5 years, but it's also the biggest loss for the past 5 years. So if you ask me for my opinion, maybe they should just stop selling their cars, because if they do, probably, this will at least be not so bad. So as you can see, NEO, very high volatility, right? You've seen earlier about 100+%, but it's not a profitable company. Now, what about GME? GME, same thing as well, right? As you can see, for the past 5 years, not really profitable, except for 2024, maybe it's potentially going to be in a slight profit, but the year has not closed out yet, so we don't really know. But again, as you can see, the revenue is a little bit inconsistent, right? Down, up, down. So again, there are better candidates for the wheel strategy. These three are not the ones that I will look for when I trade the wheel strategy. So when the stock is not a profitable company, it increases the uncertainty and risk of the stock, and it's actually reflected in the share price movement. So let me repeat that, because this is very important. When the stock is not a profitable company, it increases the uncertainty and risk of the stock, and is reflected in the share price movement. So as you can see over here, this is AMC, right? You can see that AMC is an unprofitable company, and look at the share price, right? It's so erratic. Maybe if you got into the stock maybe sometime in 2020, right, during the pandemic, and then you held on all the way until the big move up at 2021, then you quickly sell it off, maybe you're in a profit. But for the most part, you can see this is a very difficult to trade the wheel strategy stock, right? Because if you were to get into the wheel strategy right now, man, you have no idea when you're going to get out of the stock. So as you can see, unprofitable company reflects in the chart. Now, what about NEO? Same thing as well, right? It's not a profitable company, and towards the end, as you can see, the price is pretty much doing not much, right? Going nowhere. And finally, GME. GME, same thing as well. Again, all these are meme stocks, right? Sometimes back in 2021, there's this very big spike. So if you got in then, and then you made that profit, good for you. But it's not one of those stocks that I will continue to wheel over and over again. So for me, I generally prefer staple stocks when I do the wheel strategy, so I can do it over and over again, knowing that in the long term, at least there's a greater chance of it appreciating than it going sideways or going all the way down and being bankrupt, right? So as you can see, this is GME stock, and it's pretty much doing nothing, right? Just going sideways. And if you ask me, this looks more like an electrocardiogram reading, right? As you can see over here, this is the reading when, they test your heartbeat, right? So if you were to trade GME, then I would guess most of the time, whenever you get into the stock and the stock is going down, then this is where you have your heart attack, right? Your heart is going to beat much faster than before. So this is not a stock chart. This is an electrocardiogram reading chart. All right. Now, what if the stock is profitable? When the stock is a profitable company, it now decreases the uncertainty and risk of the stock, and is also reflected in the share price, right? So here's an example. Google, right? As you can see, Google doing pretty good, increasing revenue, net income, pretty stable as well. And take a look at the share price, right? Over the long term, it has been appreciating. Now, if the company is profitable, of course, there are no guarantees that it will always go up in the long term. at least the chances of it going bankrupt is not so high, right? Because it's a profitable company. And also there is a higher chance, a higher probability that the company can go up in the long term, especially if their earnings are good, they're always making money. This will reflect in their share price. Now, another company, Amazon, right? As you can see, Amazon increasing revenue, increasing net income, except for 2022. So 2022 was an anomaly because they invested in an electric automaker, Rivian, and that kind of suffered during 2022. The share price got plunged quite a bit. So only that 1 year. But after that, as you can see, 2023 is in profit again. So Amazon is one of those companies that I think is also pretty decent for the wheel strategy. And again, as you can see, reflected in the share price. So if you want to avoid the problem whereby you get into a stock and then once you're assigned, you fear, right? Because you're not sure what's going to happen. Is the market going to continue to go all the way down, or is it going to go back up, right? So if you want to reduce that risk of that happening when you get into the wheel strategy stocks, then definitely go for the profitable companies. Now, mistake number two. Now, mistake number two is choosing overvalued stocks. So at this point, you might be saying, hey, Davis, I went for, your suggestion to go for profitable companies, but after I got into it, the stock price still plunged down for quite some time. And one of the reasons for that is that it could be overvalued, right? So you could have chosen the right stock, but it is at the wrong price, right? So if it's overvalued, then chances are that the stock can still go down. So what I notice is that over time, stocks will tend to gradually gravitate to their mean value. But of course, right, valuation of a stock can tend to be subjective, right? Depending on how you calculate it and who you ask regarding the valuation, right? And what kind of data you use. However, there's still going to be a general consensus as to how a valuation of a stock is arrived. And with this valuation, at the very least, it gives us a rough estimate of where the stock price can go to. Right? So if we at least have a number, a valuation, then we can, based on it, see whether it's overvalued and it's undervalued. So you could choose a good company to do a wheel strategy on, but if it's overvalued, it still could go down. So to err on the safe side, to have a margin of safety, we want to choose profitable companies that are currently undervalued. Right? So the next question you might ask is, so how do I know what a company's valuation is? So this is a good question, and there are actually already many sites that give you the valuation of the stock, right? They give you their valuation. For example, there's Simply Wall Street. So this site is taken from Simply Wall Street. As you can see over here, they give you their valuation, right? This is of Amazon. Amazon, you can see the fair value is 336. According to them, current price 186 is undervalued. So at least based on these fair values, I know that there's still some room to the upside, right? Compared to, imagine if you go to a stock where the fair value, maybe the fair value is about $100, current price 186, then the chances of it going up, or at least the upside room it can go up, is not as high, right? Now, there are other sites as well. For example, Guru Focus, Morningstar. So what if all the different sites give you different valuations? Then you can just take an aggregate of it, right? So what I do is I like to go to a few of the sites, take a look at the value, and then I will give a discounted value as well, right? So I'll try and find the lowest one. So let's say, for example, 336 is the lowest one. Then I might even discount it even further. So maybe discount by 10, 20%. And if it's still above the current price, then you know that the current price is undervalued. So in this case, again, it gives you a margin of safety. So even if you get into the stock, at least you know there's still some room to go on the upside. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Now, mistake number 3 is avoiding assignment, right? This is a big one. So a lot of people actually get into the wheel strategy not wanting to get assigned, which is a little bit weird in my opinion, because the whole idea of the wheel strategy is to sell the cash secured put, to get assigned, and then sell the covered call. So if you're always trying to avoid assignment, then you're not really trading the wheel strategy, right? You might as well just trade the short put by itself, right? Just trade the short put and then not get into stock positions, right? That also means that you have to take loss when it's time to take loss. But if you want to trade the wheel strategy, then know that getting assigned is just part of the strategy. So there are two common things that people do to avoid assignment. So the very first one they do is they sell a cash secured put with very low delta. So maybe the price right now is somewhere around here, right? Around 148. And they might sell one that's super far away. So maybe they go for something like 20 delta or maybe even 10 delta. Now, if you are trading the short put, that means you do not plan to get assigned, then 20 delta, 30 delta, I think that's fine because you're just trading the option by itself. But if you're trading the wheel strategy with the whole idea of actually getting assigned, then 10 to 20 delta is not really going to help you with that. There's two problems with this. So problem number one is when you choose a low delta for your cash secure put, the return is also going to be low. Because remember, now there's a difference between the short put, also known as the naked put, compared to the cash secure put. With the cash secure put, you already have set aside your capital that you don't mind getting assigned on the stock. So your capital outlay is much higher. So if you're going to choose a delta that is so low, then your return is going to be very little. Now, if you trade the short put by itself, that means the naked put, you're trading based on, whatever the buying power is. So of course, the return is going to be higher. So you need to be very clear what is the strategy you're planning to trade. So if you're planning to trade the wheel strategy, you are going to commit the capital, at least choose a slightly higher delta. 10 to 20 delta is just way too far away. And the second problem with this is that if your cash secured put actually expire worthless, it's likely because the stock has shot up. So at this point, a lot of people get excited. They say, oh, wow, I sold the cash secured put and then it expired worthless. I can sell the cash secured put again. Wow, the wheel strategy is so good. But the problem is that the market most likely went up. And if you actually had gotten assigned, right? Let's say, for example, you sold the cash secured put somewhere here, and then you got yourself assigned. Now you're in a share position. Now the stock goes up. You're going to participate on the upside in terms of your capital gains. This is a big portion of the wheel strategy. So had you gotten assigned, you would have participated in the up move, but because you wanted to, avoid assignment, you sold one cash secured put that is so far away. Guess what? All you did is get that very little premium and then you watch the stock fly to the moon and you're not on that boat. Now, the second way that people avoid assignment is to keep rolling out and down. So rolling out and down is fine, but there is a certain point where you want to actually stop rolling out and down. So if you do it once just to get a lower assignment price, that means to get your long shares at a slightly lower price, that's fine. But if you keep rolling out and down for the whole idea of avoiding assignment, then guess what? Again, it defeats the purpose. So for example, let's say the market came down a little bit, they touch the cash secured put. What people will do is that they will roll out and down. So right now, they push to a lower strike price, but they also push out to a further date. So when you push out to a further date, what happens is that it takes a longer time for this option to expire. And by that time, the market could have gone past and then gone back up, and then you wouldn't have gotten assigned. Again, same thing, you would have just gotten the premium, you missed on the upside move. So what happens is that when the market comes down again, it touches the cash secured put, they're just going to keep rolling down and rolling down again. So again, this is the same problem. If your cash secured put expire worthless, it's likely because the stock has shot up. Had you gotten assigned, you would have participated in the up move. So remember, when you're trading the wheel strategy, the whole idea here is to get assigned, because once you get assigned, then this is where you can actually get the capital gains. And the capital gains, I can tell you, plays a big part in the wheel strategy. And if you choose the stock right in the first part, avoiding mistake number one, then you're actually going to have quite a bit of profits in terms of the capital gains. Now, mistake number 4 is ignoring potential capital gains. So talking about capital gains just now, this is the next mistake, right? So many people trade the wheel strategy only wanting to just make the premiums and forego the capital gains. For example, you see that this is the price where you want to get assigned. You don't mind getting assigned, so you sell the cash secured put. So now the market has gone below your cash secured put, and let's say at this point, the cash secured put expires. Now you're assigned 100 shares. So far, so good. But the problem now is that many people right now start to sell the cover call exactly at where they were assigned, right? So what this means is that you have removed any chances of getting capital gains, right? Because once the market shoots back up and then it expires, your shares get called away, guess what? You only get the premiums for selling the cash secured put and the covered call, and you miss this whole gain upward. So again, no capital gains down there. So what you want to do instead is wait until the price actually goes up, right? And then two ways you can do it. Either wait until the stochastics oscillator is overbought, then you start to sell the cover call, or wait until it reaches its value, right? The valuation, like I mentioned in mistake number 2. So this way, at least you can secure some capital gains, which again can play a very big part in your profits in terms of the wheel strategy. So like I mentioned, not many people realize that capital gains is actually the biggest potential profit portion of the wheel strategy. And if you didn't make mistake number 1 and did your due diligence on choosing the right stock in the first place, then you actually don't have to worry about the stock not coming back up. So one of the reasons why a lot of people want to sell the cover call at the price which they were assigned was because they fear that the stock is never going to go back up, right? They fear that the stock is just going to continue to go down or maybe come back up sideways, and then they're going to sell the cover call, right? But if again you chose the right stock, then in the long term, the stock will go up. And then this is where capital gains can really come in to help increase your returns. Now, the final mistake number 5, and this is the one that I also get quite a lot of questions on, is selling your covered call below your entry price. So many people sell their cover call below entry price, hoping to further reduce their cost, right? So let's say, for example, this is where you got assigned the 100 shares, and then the market starts to go down from where your entry price is in terms of where you assign the 100 shares. So a lot of people panic down here. So they want to quickly try and reduce the cost of these shares by keep on selling this covered call. And this is what they do, right? So they sell the covered call below their entry price. Now, all this is good if it continues to trade down here and your cover call never really gets tested, and over time this really helps to reduce your cost of this 100 shares which you got assigned down here. However, one of the big risks is, what if the market just suddenly starts to shoot up, which can happen. And if the market starts to shoot up, the problem is that they can't really roll the cover call anymore. Many people think that they can just keep rolling the cover call up and out once the stock goes up to their cover call. But you will find if it hits too quickly and the move is too fast, then it's very hard for you to roll up and out your cover call. And when they can't do that, now what happens is that you're stuck with a cover call that is below your entry price. And finally, when the cover call gets assigned, guess what? Your shares get called away at a price lower than where you entered, which means to say this gap down here is your loss, because what you have essentially done is that you have bought at this price and you sold at this price, giving you a capital loss. So don't even talk about getting capital gains. Right now, you even have capital loss. So it's very important to be patient when you're trading the wheel strategy and not always feel the urge thinking that you must be selling something all the time. It's not necessarily true. You can just hold on to the stock, wait until it finally goes back up, and then you start to sell the cover call. So again, all this comes down to choosing the right stock. So if you had already chosen the right stock at the start, especially if the stock is profitable and you've seen that over the past 10 years, maybe even 20 years, the stock has always been going up even after market crashes, then you have lesser reason for you to worry, right? You only worry if you start to choose those stocks where it's not profitable and it's very high volatility, and you just enter it because you hear that the premiums are so high. So what do you do if the stock is now below the entry price and then you cannot really sell the covered call at or above the entry price? Well, you have two options. The very first option, number 1, is simply do nothing. If you had chosen the right stock in the first place and believe in the fundamentals of the company, just wait for it to go up before selling the covered call. So again, like I mentioned, all this all ties back to choosing the right stock. The whole success of wheel strategy really just comes down to choosing the right stock. Now, if option 1 doesn't work for you, then you need to go for option 2, which is to close the position for a loss. When do you do this? When you are no longer confident in the stock and you don't believe in the company's fundamentals, then there is absolutely no point holding on to the stock and hoping it goes up. Because if you don't truly believe in the stock, you don't think that, in the long term it's going to go up to its valuation, then get out of it, right? Because no point for you to hope and pray and then you get into more heartache, sleepless nights for no reason. That is why, again, as you can see, many times I've emphasized in this video, choosing the right stock for the wheel strategy is the primary factor to determine if you will be profitable. So here's an example of Google. So Google, as you know, is one of the stocks that I wheel, and it has done very well for me. And as you can see, back in 2022, the whole stock market pretty much went down. Google was no exception as well. As you can see, it went down. Now, during this time, a lot of people just get fearful and they exit their positions, thinking that, oh, it's going to be a market crash and this time it will be different. There's always this little voice that appears in your head that tells you that, oh no, maybe this time is different. Only when the stock recovers, then you realize, oh, it's the same as the past few crashes. So the market went down in 2022. A lot of people panic. They quickly sell off their stock for a loss, only to regret it later on because the market eventually recovered. And during this time, I've actually been wheeling the stock as it came down. I even have a video on it doing the wheeling on Google and also on Amazon. And same thing as well for Meta, right? Meta was another of the company where I did the wheel strategy as well. I did some leaps on it as well. So again, 2022, Meta really went down, right? As you can see, this is pretty much a crash from $400 thereabouts. It dropped all the way to about, I think about $100 or maybe under $100. That's a very big move down. Now, during this time, a lot of people panic as well. They sell away their stock. But I didn't do that. I continue to do it because, again, I have the firm belief, especially in the fundamentals, right? The company is profitable, is doing well. Chances of it going to bankrupt is not as high as like AMC, GameStop, and even Neo. So as you can see, in the end, it recovered. And that's where, again, the wheel strategy going to help you get the profits from the capital gains. By the way, I just realized that I put the number wrong. It should be number 5. So just ignore this. So let us go to the recap. So mistake number 1. Choosing high volatility stocks and not profitable companies. So if you want to at least have a smoother journey when you're trading the wheel strategy and not have stressful and sleepless nights, then choose companies that are at least profitable, right? Don't go for the ones that is high volatility only. Mistake number 2, choosing overvalued stocks. So err on the safe side, just go for the stocks that are currently undervalued. Then you can start planning out your wheel strategy. And if you want to find out what the valuation of stocks is, just simply go to any of the sites which I mentioned earlier. Mistake number 3, avoiding assignment. Remember, again, capital gains is one of the big part, the potential profits of the wheel strategy. So the whole idea is to get assigned. So definitely you do not want to avoid assignment. Once it's below your cash secured put, let it get assigned and then ride the stock on the way up before you sell the covered call. Mistake number 4, ignoring potential capital gains, like I mentioned earlier just now. And finally, mistake number 5, and that is to sell covered call below your entry price. So if you do this, you run the risk of the market suddenly shooting up past your covered call, and now you're stuck with a covered call that is well below your entry price. And when it gets called away, you're going to be called away for a loss. So do yourself a favor, avoid these 5 mistakes, and you will see that your wheel strategy will start to do better and you have much better sleep at night. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.